welcome to Real Vision Live. I'm the host here, Ed Harrison. I'm talking to Jim Bianco, the president of Bianco Research over in Chicago. Welcome to the program again, Jim.
Thanks for having me again.
You know, I'm going to start it off this way. This is a quote for you. Revelation 6:2. I looked, and there before me was a white horse. Its rider held a bow, and he was given a crown, and he rode out as a conqueror bent on conquest. That's the first horseman of the four horsemen of the apocalypse. I think that that's a fitting way for us to talk about what we're going to talk about today, because it does seem very apocalyptic, the things that are going on, especially in New York right now.
Yeah, it is. It is, you know, right out of the New Testament, as you were quoting as well too, that we thought we were immune from a pandemic, given the medical technologies that we had. But I think what we're learning is that was more than offset by our ability to travel. That you can have all the medical technology you want, but if you have 200,000 planes in the sky at any given moment, taking hundreds of thousands of people crisscrossing the globe, that when the Black Plague took 40 years, this takes 40 days. And that's what the big difference is between those two instances. But yeah, something no one ever conceived that was going to happen.
Definitely. And, you know, let's go back to the beginning, because, you know, I'm looking over and I see your screen up with all of the alphabet soup of stuff that the Fed has done. Because the Fed has gone from what it did in 2008 and sort of up the ante. I think the term that you use is nationalizing markets. So we can start there in terms of the response to this apocalyptic real economy shock. What is the Fed doing?
Well, the Fed has, I think, correctly acted in that they've learned the lessons of '08 and before, that when the economy has a shock, you go big and you go hard, you go right away. It's easier for the Fed to overdo it early and pull back than, oh, we got to hold back a little bit in case it gets worse, so we have something else to cut. That's an incorrect way to view it. And so the Fed cut rates to zero from 1.5% between meetings, including a 100 basis point cut 2 Sundays ago. They provided liquidity at $1 trillion a day to the primary dealers. They are doing $100 billion a day plus of QE bond purchases. They did $600 billion of bond purchases last week. I might add, QE1 in 2009, which took 9 months, was $600 billion. They did that in 1 week already. That's all within the Fed's legal mandate that they can do that. It's large, but it's in their legal mandate. The list you're looking at is the alphabet soup of programs that they brought up. Each one of these is a different program. Now, let me bottom line this. The Fed can't do any of this stuff. They're only, see, the Fed by charter cannot take a loss. So they can only invest in things that they cannot lose money. Treasuries, agency securities issued by Fannie and Freddie because there's an implicit government guarantee. Mortgage-backed securities that have a guarantee from Fannie and Freddie. Maybe municipal bonds, but they haven't gone there. They've talked about it yet. But none of this stuff. This is purchasing of commercial paper. This is from the issuers directly in the secondary market, purchasing of corporate bonds inside of 5 years maturity, buying ETFs tied to corporate bonds, purchasing and backstopping asset-backed securities as well too. So how is the Fed able to do this? And this gets to my nationalization argument.
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1 to get a month's access to this incredible treasure trove. I don't think you can afford to be without it.
The Fed's not doing this. The Treasury is.
Right.
For each one of these programs, they've created a fund, a special purpose vehicle. Each one of those funds, the Treasury puts $10 billion into each fund. Then they put this fancy language up, and they will be at a first loss position. Well, I own Bianco Research. I know what first loss position means. The owner, me, takes the first loss. So what that means is the Treasury is the owner of all of these special purpose vehicles. The Treasury is buying all this stuff. The Fed is providing the financing for it. And last week they hired BlackRock to do all the trades and to do the administration of the fund. And so that's not COVID, by the way. It's my seasonal thing that's coming up to me.
Right.
So what's happened is that the Treasury and the Fed have merged, and they've become one entity. Now, they did this in 2009, but in 2009 it was much smaller. No one understood it in 2009. And they said, Ben Bernanke, the chairman of the Fed at the time, you run this program, and he did, and he got out right away. And so we sort of nationalized markets for a little while, and then we stopped doing it. Now it's 2020. It's much bigger. We understand these programs. We understand the implications of these programs. And I might add, we have a president who's been very critical of the Fed. We have a president who wants negative interest rates, who wants the Fed printing money like crazy, who has said on many occasions pre-virus, the Dow would be 10,000 points higher if the Fed had done the right thing. Now that we've merged the Treasury and the Fed, these are Treasury programs. Donald Trump, through Steve Mnuchin, runs these programs, not the Fed. When the Fed says, okay, it's time to stop, Trump has to agree. He could say, no, they're my programs. Keep giving me financing. We want to keep doing more and more and more. And by the way, if you're buying ETFs, LQD and AGG and BND, the bond ETFs, slide over and do some SPYs while you're at it as well, too. And print up the money to keep doing it. We hope he doesn't abuse the program like that. Right. He won't initially, because right now we're in the middle of a crisis. But that's the risk that we face, the loss of independence of the Fed. So this is what they
had. Isn't that independence totally fictitious? I mean, we're seeing that right now. I mean, my argument has always been that the Fed is an agent of the state. That is the state is Donald Trump, the executive branch, and when push comes to shove, they will fall in the line with the executive branch.
That's exactly what they did. They fell in line. They basically turned over the printing press to the executive branch. Right now, we have to hope now that given that power, and again, that's not an immediate concern today, tomorrow, because the economic data is going to be bad for the next several months. But I'm thinking more on the times when we get, into a recovery. It will be bad now. The virus will pass. We will restart the economy. Things will get better. There will come a time at that point when we're better that we say, some of this stuff might not be needed anymore. Will the executive branch agree and say, no, it's time to start pulling it back? And by the way, that might be weeks before an election. And do we want to risk another tumble in markets weeks before election, or just keep the printing press going, boys? I want to get reelected here. That's what we have to worry about as we go. So you're right that the Fed has merged with the Treasury. I understand they needed to do what they needed to do. You could be high and mighty, and you could have said, no, the Fed should have done none of this. They should have stayed out. I'm as libertarian as anybody else, but this, and I'm not saying that we shouldn't be libertarian. We were never set up to be that way in the first place. And if now you want to pick one of the biggest crises of our lifetime and say, now we need to be libertarian, it's kind of like finding somebody who just got a knife stabbed into them and then start lecturing them on their bad behaviors that required them to get stabbed. Look, deal with that later. You have to deal with the immediate problem that you have right now. And then that's where
let me interrupt you on that, because I think the question is about liquidity and solvency in terms of dealing with the problem. I mean, the way that I've been framing it is that the Fed has taken that alphabet soup that you were talking about, which we saw in 2007 and 8, and expanded it to the list that you're talking about today. And the reason that they did that is because the liquidity was drying up in so many more markets in 2020 than dried up in 2007 and 2008. They were forced into it. But the problem always is, going back to the Badgett rule, this is something I've mentioned to you before, is how they go about that. How do you decide who's illiquid and who's insolvent? The way that I'm looking at it is they said, look, every single market in the investment grade universe, and actually below the investment grade universe, is illiquid now. So we need to decide, okay, we're going to nationalize the markets where there's a minimum of credit easing on our part. We're going to go investment grade. We're going to go money markets. We're going to look into all these markets, but we're going to exclude junk. We're going to exclude equities. And the reason that we're doing that is because those are residual asset classes, and there's too much credit easing associated with our getting into those markets. What do you think about, one, the Badgett rule, the fact that they're intervening at, making whole a bunch of people who shouldn't be made whole, and also the fact that they are effectively doing some level of credit easing by intervening in less than pristine paper?
Well, I agree that they should be doing the Badgett rule, and they've been not doing that for a long time. And the last example of them not doing the Badgett rule was, the whole repo intervention that they started in September. I used to call them, instead of being the buyer of last resort, they were the buyer of first choice during the repo crisis. They made in advantageous terms. And they seem to be doing a little bit of that right now, too, with a lot of these rules, is that their attitude seems to be, instead of holding the system together at a bare minimum, they seem to want to try and return us to January 2020, pre-virus. They want to make sure that everything is okay where it was pre-virus. That's unrealistic on their part as well. So as far as the Badgett rule goes, I think that they would be better off doing it in those terms. I'd like to say, it's like if you ever taught your kid how to swim, you kind of put your finger under their nose and you just hold it slightly above the water and let them paddle for dear life to learn how to swim. That's what they need to be doing with the markets, not putting 15 floaties on the market to make sure that there's going to be no problem. So they're doing a little bit too much. But let me mention about the illiquidity. And think about generals fighting the last war. What happened in 2008 was the banks levered themselves too much. And we learned that, all the way to the 40-to-1 leverage with Lehman Brothers and Repo 105 and all that other stuff that they did. So we spent the last 12 years putting together rules so that the banks would not repeat 2008. And those rules, I think, have accelerated what we've done now. And what is it? First of all, it's not just the Fed. It's the BIS, it's Basel, Bank of International Settlements, it's Basel III, the European Banking Group, the ECB, the Fed, the FDIC, the OCC, up and down the line. They've put together all these rules to prevent banks from levering up. Remember now that the fixed income market is largely a dealer market. What does that mean? That means if I'm a fixed income portfolio manager and I want to sell my securities, I sell them. I call up a dealer, JP Morgan, Citi, Goldman, take your pick, and I sell my securities into their inventory. The stock market's a little different. It's a platform. I put a bid out on the stock market or in the futures market, and I wait for somebody to match it. And we just meet there, and the trade is done. And it isn't I'm waiting for somebody's balance sheet to show up and do it. So what happened in early March is everybody looked around and said that the virus is bad. There's going to be a repricing. Sell, sell, sell all my fixed income securities. The dealers bought. They hit their limit. They hit the limit of their balance sheet. And then the Fed offered repo and everything else to say, expand your balance sheet to continue to make markets. The dealer said, I can't. And they said, why not, dealers? Because there's too many rules. The Fed said, I'll waive my rules. It's like, no, it's you and 28 other people that have prevented me from doing this. So I'm stuck. I can't make markets anymore. And that's been the problem with the illiquidity, which I think the Fed is trying to address by saying, well, if the dealers can't do it, because we set up all these rules because we didn't want a repeat of '08, which is actually making 2020 worse. The Fed is going to attempt to do it in their place right now.
That makes a lot of sense.
I'm sorry?
I said that makes a lot of sense, and obviously you were saying that the question is not whether they should do it, but how they should do it. I cut you off a little bit, but I want to ask you about, we were talking before we got on about the Taibbi article. He has this article that came out. It is called, it just came out today, Bailing Out the Bailouts. And he says it will take years to sort through the details, but this bailout looks like a double down on the last disaster. I think a lot of people are feeling like, it's a bailout. It's not actually a necessary liquidity problem, but rather a bailout of the existing players. What do you think of that take on what's happening right now?
I think that's exactly what it is. And I think that the assumption underlying that is the economy was fine. We're going to go through this virus, and then we're going to go right back to where we were before. And so therefore, we need to have these bailouts structured to try and keep everything at January 2020. Nowhere in there is this mentality that, and this is what I believe, this is the biggest event of this generation, that we will forever know this as the pre-virus and post-virus era, that the post-virus era will be different than the pre-virus era. It doesn't have to be disastrous. It doesn't have to be disastrous, but it will lead to deglobalization, less risk-taking. Look, Mr. Airline, you can't spend 96% of your money buying back your stock. You need to hold back some reserves. So when you get into a problem like this, you don't need a bailout. That's a less aggressive attitude. That will lead to lower earnings, lower multiples. I'm trying to put this in investment terms as well. And that's the environment we're going into. But what these bailouts seem to be structured is, no, we're going to go right back to January 2020 when this is over with. No change in attitude. And that's where I think the mistake is. I agree that if you said, look, we're repricing from one era to another era quickly, and that's painful, and that could create an overreaction, and it could create unnecessary bankruptcies and be chaotic. Let's try and manage that decline from one era to the other. I'm with you. But if you're going to set these programs up to say, no, we'll get past this and we'll go right back to Trump tweeting about how great the stock market is and be sure that you're levered up in your 401ks all the way up to your eyeballs like he was as late as January. If that's your attitude in putting together these bailouts, that's the wrong attitude. And it looks a little bit like that's what they're trying to do with these. So I think the idea is right. I just think, what is it that you're trying to accomplish? If I was there, and I might remind you that I was interviewed to be a Fed governor last year by Larry Kudlow, and I would say we're transitioning from one era to another. Let's help make that less chaotic. But understand, we're going to a lower, different era. We're not trying to bridge us back to what we had before.
Well, let's talk about that move to the different era, because we're in this eye of the storm period where we're making that transition. The data flow that came out, I saw the ADP numbers. The ADP numbers that came out today, as an example, are only through March the 12th. At which point none of this stuff happened. So to me, the numbers that we're seeing right now on the market are pricing a level of risk or level of transition that is not the level that we're going to see, the one that you're talking about in terms of deglobalization and a bunch of other things. How do we make that transition? Is it going to be a hard transition in terms of the markets? What do you do in terms of protecting your assets when we're making that transition?
Well, I think what you have to recognize, one, is that if it is going to be a different environment, and what we're talking about here is not what's going to happen in the next several months. We know what's going to happen in the next several months. It's going to be very bad. Then the virus will peak and we'll go back, and then we'll restart. So we'll have a V bottom. But when we restart and regain economic momentum, we're not going back to the old high. That's your L. If you use all the economist words, we'll come up short of that old high as well, too. So recognize 3,400 on the S&P may not happen again for many years. Or if it does, it will be in a devalued, inflation devalued way, because I do think we're going to have some inflation on the other end. And I'll talk about that in a second. So bear in mind that we're going to a different era. I think a lot of people, there was a recent YouGov study that 66% of investors have not done anything to their portfolio, and that actually more people said that they bought during the decline than have sold during the decline. So they've net added to their positions on the way down. They're assuming that when this virus passes, that there will be no long-term consequences. And that's what I've been trying to focus on, is the long-term consequences. I think it's going to be deglobalization. It's going to be de-risking. I think that all of the stimulus that we're stuffing in, $4 trillion from the Fed, $2 trillion from the government. Trump just yesterday said another $2 trillion is coming in infrastructure spending as well too. And Nancy Pelosi saying, yeah, and when we're done with that, there'll be another one on top of that. That's 25 to 30% of GDP. That is going to be an enormously large number. So that on the way down, you won't see it, but on the way up, some of that stimulus will lead to excess demand. It will lead to us being able to bring the processes and businesses back from China here to produce them at higher cost, which would produce higher inflation, higher interest rates, lower multiples. So what I'm trying to say is, prepare yourself that when everything shakes out and it is all said and done and we've recovered, you're looking at 2,000 to 2,200 on the S&P, and probably an overreaction first. Look, we're 2,500 right now on the S&P.
Right.
Maybe it's not 2,000 to 2,200, but all I want to say is, stop thinking that this is the buy of a lifetime. It might eventually become that, but I don't think it is just yet. The buy of the lifetime mentality is, let's assume what the administration said yesterday. 100,000 to 200,000 people die over the next several weeks from the virus in the United States alone, more in Europe, more in the rest of the world. We're going to forget that, and we're going to go right back to January. If you believe that, then you're right to be buying. But if you think that that type of death rate, that type of pain is going to change attitudes, we're not going back to the old highs. Now, we're not going to have a Great Depression. We're not going to fall apart. We don't, or maybe I should say, we don't have to.
Right.
It's fully within our capability to manage from one era to the other era without it being a disaster. But if too many people are demanding a return to January 2020 after this is all over with, I think there's going to be some disappointment. And again, that can, in my mind, only happen if we collectively forget what is happening in New York and what is about to happen over the next several weeks. That is just completely forgotten. And I don't think it will be. And that's why I think that there will be long-term consequences.
So now when you talk about that, you're talking a lot about stuff at the federal level, especially in terms of stimulus that's being added. Obviously, the states are in a different position because they're not operating in a fiat currency that they can just print off. So you're looking at U.S. state level austerity. Can you talk to me, A, about what that looks like in terms of the impact on the economy, and also, B, what it looks like in terms of the municipal bond market and the potential that the Fed adds munis to its list of places where it's bailing out the market? Right,
you're right. The states do have a fiat currency. California and Illinois have issued IOUs. So if you're a vendor to the state and you provide them a service, they don't pay you. They just give you a piece of paper saying, I promise to pay you someday in the future. So that's kind of what they've done. But that's a very limited degree in terms of what the states are. Look, the states and the municipalities are going to be the big problem. They're going to have a huge loss of revenue. They're going to see a big decline in the amount of tax take that they're going to be bringing in through unemployment and through other things as well too. So the Fed is now openly talking about hoping to have a bailout the municipalities. They don't need to change the Federal Reserve. It's debatable whether or not they need to change the Federal Reserve Act, because those might be guaranteed securities in some way or shape. But they're going to try and do that as well too. I think the municipalities, to come back to my next argument, they have to understand that they're not going to get back to their old revenue, that the union workers, the city workers, the state workers, with their pension plans and their contracts, they might not be able to meet those at 100%.
Right.
Now, if we do it right, they might be able to meet it at 90 or 85%. If we do it wrong, they might have to meet it at 60 or 50%. And so if we all understand what's coming next, it can be managed. But if we're all going to sit around and demand, no, I demand my state pension exactly the way it was in January 20. I demand my state pay exactly the way it was in January 2020, and I demand it never to be changed. Look, it's going to hit every single person. There's no one that's going to be escaping from this. So I think that the states are probably going to have a problem, and the Fed is probably going to step up. Look, Boskin has already talked about it, and a couple of other Fed governors have already talked about offering municipality relief in terms of the Fed stepping up with their printing press as well, too.
You know, when you say that, the first thing that came to mind is something that's a little far afield. I saw a tweet by a guy, Paul Butnik, over in Europe, and he says, try to explain to a Dutch train driver who, one, retired at age 66, two, hasn't seen his pension go up in years, and three, will see his pension go down in real terms because of the corona measures, that he has to bail out a French train driver who retires at 52 because of solidarity. So the issues that you're talking about right now are in spades in Europe as well. The whole concept of the pension thing, and then you add the twist of the solidarity. I know you and I, we were talking a little bit about this before, and this is an abrupt jump from what we were just talking about, but that's the first thing that came to mind, that those are the same issues in Europe. Can you talk to those issues?
Yeah, you know, we have the European Union, and we have now in the European Union's, you know, post-World War II period, arguably the biggest crisis that they've faced. The Germans have correctly come out last week, and they've kind of said something along the lines of, German taxpayers, you have to be ready to help assist Italy and Spain with their crisis right now, helping them. And the Germans, I think, are 100% right. This is a European Union. And if you don't step up and have assistance to Germany and assistance to Spain in their time of need, then Italy and Spain have every right to leave and end the European Union. Think of it this way in the United States. Suppose the rest of us, you're in Maryland, I'm in Chicago, we said, oh, a hurricane hit Florida. Oh, it didn't hit Maryland, didn't hit Illinois. Why should we provide any assistance to Florida? You're on your own, Florida. And Florida would be right to say, well, then if you're going to have that attitude, maybe we'll just leave the union. We'll become our own separate nation then at that point with our own separate rules and everything else. That would be chaotic. So the Germans are arguing that that's going to have to be. Understand that that train driver that's going to be watching, you know, in Denmark he's going to have to take a hit. Every single person is going to have to take a hit. No one gets away from this unless they do start to structure this in a way that some people get 100% bailout. That would be very bad. But if we start, like I said, if we think about we're managing from one era to another era to make it less chaotic, I'm fine with that. But if we think that we're going to try and keep everything the way it was, Europe in the same way, we're going to have a problem. So if you are a European Union, now is the time to step up and help those that are in critical need, Spain and Italy. Otherwise, what's the point of being a union? And it'll just fly apart, and we'll go back to 18 different currencies in Europe, and we'll go back to all the 18 different rules in Europe, and it'll go back to where it was in the 70s, which was not a good place for Europe to be at that point. It was impossible to do business in Europe because you had to do it in different currencies. Every country had different rules. Every country had a different language. It was very difficult to do anything in Europe. That's your risk if you don't act like a union right now.
And I'm hearing that there's maybe a quid pro quo in the offing, because one of the things that people are talking about now that's different in the future that wasn't in the past is so-called Corona bonds, or Euro bonds is what they used to talk about them as, and that is a mutualization of debt. And the Germans and the Dutch in particular are very negative on that. Do you think that that's a must, that we're going to see that for sure if we're going to keep the cohesion that we see in Europe right now?
Yeah, that is a big point of contention. So Corona bonds or Euro bonds, the thing about a Euro bond is, so everybody understands what we're talking about, the 18 different countries that make up the Eurozone. Greece issues Greece bonds, Italy issues Italy bonds, Spain issues Spanish bonds, Germans issue German bonds. And then each country is responsible for the debt that they raise. They've talked about this idea, why don't we just issue Euro bonds? And the complaint there, especially among the Dutch, the Austrians, and the Germans, is those bonds will have our credit rating because we're the strongest partners here, because everybody will assume we will bail out those bonds. And that will give Greece and Italy and Spain an incentive then to overborrow, because they can get away. There will be a loss of a market signal, if you will, that the market won't continue to put premiums on their bonds because they're borrowing too much money, because they're borrowing at German credit rates. So the Germans have pushed back on that. The argument has been, well, we need Corona bonds, which is a form of that, for the bailout. But the Germans have come up with something rather interesting, in that they have been pushing this program called OMT, which is outright market transactions, which you and I would know as QE. That the ECB would just buy bonds and print money and buy bonds. The Germans, to be blunt about it, have been against that, because that sounds a lot like the Weimar Republic, and that's a very sore subject with them, correctly so. But their argument is, no, we don't want to do Corona bonds. We would rather do OMT. Italy, Spain, you issue bonds, the ECB will print the money, help buy those bonds to help support that. Why OMT? Because we could turn that off. We could turn that off in the future. Once Corona bonds start, that will be Ronald Reagan's argument. The closest thing to eternal life is a government program. It will go on forever and ever. And then they'll redefine Corona bonds is part of the bailout. Every hairdresser in Spain gets to retire at 50, so we have to issue more bonds so they can all retire. It's all part of the bailout of the coronavirus. And where do we draw the line on that? So that is a big debate that's going on in Europe. I understand the Germans' argument. Do OMT, because we can always just by committee just tell the ECB one day, enough, we're done. But once you start a Corona bond program, it's impossible to say, okay, no more Corona bonds anymore. That's enough. You've raised enough money. You could stop doing it. It will live on forever and ever. And they will forever be saying, wow, look how much money we could borrow in Spain, because it's the German rates. And if we borrow too much, Germany's got to pay it. And so that's why they've been pushing back against that. And that's why I thought it was an extraordinary admission by the Germans to say they'd be willing to do something they were never willing to do in 2008, and they were never willing to do in their prices in 2012. And that's OMT, outright market transactions, or the ECB doing QE. So they're recognizing this is a big deal, and they need to do something, but they don't want to make it permanent.
The sense that I get, though, is that there is we're at a crossroads there. That is that Spain and Italy are definitely saying, OMT is not enough. We need Corona bonds. And the people who are on the fence are the French. That is that the French are escalating. They're country number 3 that's going to pass China soon and pass Germany in terms of infection rates. They're going to be in problems. I think that the French have the potential to tip it towards Corona bonds, and then you're in an existential crisis in terms of what do the Germans do, what do the Dutch do in that case?
Right, and I think you're right about the French, that they'll pretty much decide which way that they wind up going. And the thing that happens when you go to Corona bonds is the only other fix is look at the United States, right? You then have to stop thinking of yourself Once you go to Corona bonds, you start borrowing. You stop thinking of yourself as Spanish or French or Italian or German, and you start thinking of yourself as European. And your capital is no longer Berlin or Paris or Milan or Madrid, but your capital is now Brussels. Are you ready to go there? Are you ready to start thinking of yourself? See, the problem with the Corona bond argument and everything is it's the free money argument. It sounds like a great idea. Well, the only way to get control of that program is we then have to start calling ourselves European, and we have to start thinking about taking our orders, not our orders, but our government is now in Brussels. And boy, that's like showing Dracula the cross for a lot of Europeans, that they hate that idea. But that's what comes with a Eurobond program. Are you ready to go there? And the answer is no. So you really shouldn't be going to a Eurobond program. But I agree with you. It's going to be the French. I think the French were initially against it. But as the case count and the death count piles up every day in France, they're thinking about the sheer amount of money. They're thinking about the sheer amount of anger. Look, they already had the Gilets Jaunes yellow vest protest before this happened. And so they're thinking about all of the needs and the anger that they're going to have leading up to this. And that they're every day, I think they move a little bit closer to a Corona bond, which would be a titanic change for Europe if they were to go that route.
You know, there's speaking of Titanic, there are a titanic number of questions that have piled up while we've been talking. So let me start to go through some of them, not in any particular order per se, but here's the first question. It's from Dwayne. He asks, how does the battle between the printing bonanza by the Federal Reserve, ECB, and BOJ versus the global dollar shortage play out, and what are the implications for Euro, USD, JPY?
Okay, so let's put some terms on this as well. Deutsche Bank did an estimate that if you added up all of the central bank intervention worldwide, that it is technically unlimited, but it is running at a $30 trillion a year pace. That is larger than the capitalization of the United States stock market. That is how much money that they have committed. As I mentioned to you, $500 billion a week alone is just the Fed buying Treasury securities. Now, the global dollar shortage. The dollar is the reserve currency of the world. Now, that has lots of meanings, but one of the more important meanings is that's why most trade, almost all trade, is done in dollars. That's why it never occurred to you probably that the price of oil is priced in dollars. The price of gold is priced in dollars. You never see the price of oil priced in euros or in yen because we're the reserve currency. So there is going to be a big need for the rest of the world to have dollars to restart their economies, to trade with each other. The Chinese have a giant need for it because they need to buy copper and aluminum and iron ore and oil to restart their factories to make stuff as well. Also, in this era of crisis in markets, I think investors around the world have correctly said, I need to have my money in dollars. So currencies have been falling. If you've got my screen up here still, let me just run to a quick chart here. The dollar index, first of all, soared. That's a huge move in the dollar index. And then it backed off. And I'll talk about the back off in a second. But the next chart that I wanted to show you, let me see if I can find it here real quick, is the emerging market currency index collapsed. No one wants to hold these. They want to hold dollars. That has created a dollar shortage, that the dollar has been soaring. The Fed has stepped up, going back to my previous chart, and they offered swap lines. What does that mean? They offered swap lines with other central banks. In Europe, investors say, I don't want to hold euros, I want to hold dollars. So Mr. Bank, Deutsche Bank, Credit Lyonnais, here's a bunch of euros, give me dollars at the prevailing exchange rate. The bank runs out of dollars, they go to their central bank, the ECB, and they say, here's a bunch of euros, give me dollars. The ECB has an inventory of dollars. They run lower out of it. And then they go to the Fed and they say, Fed, we can't create dollars. You can. We could create euros. And the Fed says, okay, create some euros. I'll create some dollars and we'll swap them. and we agree then at a future date to undo that trade. That's the swap. But we'll roll it over. So the Fed has been providing dollar support through the swap lines to help hold down the price of the dollar. Because if the dollar keeps rising and rising and rising, that ability to buy copper or crude oil or anything else goes up and up and up and up, and it makes it more expensive to restart your economy. Problem we're facing with this is they can only do swap lines with countries that have convertible currencies. So they've done it with the big four: England, Europe, the ECB, the BOJ, Swiss National Bank as well. They've expanded it now to a couple of other countries: Australia, New Zealand, Mexico. But they really need to expand it to, looking at my chart here, to the emerging markets. That's where the real need is. But they can't do a swap with China because China has a currency that is not convertible. And so that's been their sticking point. In the past, the way they got around that was China had a big need for dollars is the Chinese would go to the Russians would go to the Swiss, the Swiss would go to the ECB, and they daisy chain it eventually all the way through to them. But now everybody along that daisy chain wants dollars, so it never makes it to them. So this is why we've got this great dollar need. So the Fed is printing dollars and sending them over. Also, bear in mind that the optics of them doing a swap line with China would look very bad. Right? China sends us a virus, kills 100,000 people. We print money and send it to China. That would not look good at all as well. So what we're looking at is an enormous dollar need that has been causing the dollar to go up. The Fed has been trying to stop that through these swap lines. And if I go to my chart, that's why if you look at my chart here, the dollar had this big rally. Then they opened up the swap lines. It fell. But it's not enough, and it's starting to go back up again. So I think ultimately, as long as we're looking at horrifically bad economic data, as long as we're looking at a gigantic need for dollars. Remember, in normal times, China would have had trade with the rest of the world. Remember, all trades in dollars, would have generated dollars through that trade, would have used those dollars to buy the stuff they would to continue to keep the perpetual motion machine going. There is no trade. They're trying to restart their economy, but once they get their factories up and running, Europe's not buying anything from them right now. The United States is not buying anything from them right now. We're not trading as much. We're not even allowing travel. Our economies are contracting. So they want to continue to acquire dollars. I think the Fed will try through their swap lines to hold down the dollar, but I think ultimately the dollar goes up. I think ultimately currencies will continue to be devalued. And ultimately, that will cause more problems because they will look and they'll say, it's getting more expensive for me to buy the material that I need in order to continue to have my economy move forward because all trade's in dollars. And the final thought for you on this, do we ever get rid of the dollar as the reserve currency? Yes, the second that you come up with an alternative. There is no alternative.
Yeah, well, that's a good question, and here's the corollary, because we have a question on that. If what you're saying is true, and I looked at those two charts, it would suggest to me that if you look at DXY and you decompose it into the G7 or G4 that you were talking about, and then the rest, that emerging markets are going to take it on the chin. So. Right. Roy is asking, how soon do you think before the G20 comes out and announces a mega package to increase the IMF's war chest to save EMs in particular? If the global lender of last resort, the IMF, is not given a bazooka, will the global economy end up in a Great Depression?
Well, I think that's coming shortly. And the IMF has to come up with it, because if I go to my emerging market chart, this is going to continue to fall. And it's going to continue to fall, and that's going to make it put more and more pressure on those emerging markets in order to come up with the dollars needed. But the problem is going to be that while they could come out with that package, there's in that EM list is China. And that is going to be, they're going to be the ones that have the biggest need for dollars. They're going to be the ones that are going to be the most politically difficult to hand them dollars through the IMF. They gave us this virus. They gave us this pain and suffering. I'm not even going to go whether or not it was intentional or whatever, by accident, it came out of China. It came out of a market in Wuhan. That much we know. So for the rest of the world to start to look like, well, we're going to support China could be a very bad optic. But without supporting them, then you start running into that real problem. So yeah, I think the IMF is going to come into that package. I think that they're going to have to, they'll look at India, they'll look at Latin America, Brazil in particular. They'll start looking at trying to do that support around the edges. But when it comes to China, it's going to be, they're going to be the ones that need it the most. They're the factory of the world, if you want to think of it in those terms. And they're going to need those dollars to restart that factory, whether or not we're going to pull out later on. We need them to restart now because that's where the stuff is made now. We could talk about whether it's going to be made in 3 years later, but we're going to need, but that's going to be a very politically difficult thing for us to do. So I do think the IMF will step up, and I do think that they'll do what they need to do, and then there'll be the China question, and that one's going to be difficult to answer.
So on the same currency question, let's go to the physical versus paper gold question. I was talking to you about that before because we had one question from David. He was saying, Jim, what is your take on the ever-widening dislocation of the physical versus paper gold market? How do you think it will play out in the near term, intermediate term, and long term? And let me just add my own thinking about this because we're talking about currency. Is anything going to replace the dollar? Talk to me about gold and also crypto in that sense in terms of the dollar standard.
Yeah, so let's talk about what it is that you're trying to do here with gold. You're trying to get your money out of the financial system. There's no real good way to get your money out of the financial system, but gold is probably the best way to do it. But the popular ways to buy gold through a futures contract, through GLD, your money's still primarily in the financial system, solidly there. It hasn't left. It's just another asset class within there. And you mentioned this to me offline, and I'll completely agree with it. It is subject then to being used for margin calls and for other things that are away from the dollar. So I think the financialization of gold is what's holding it back. The proper way to get your money out of the financial system is to buy physical gold. The premiums of physical gold is trading over the COMEX price is enormous. It's 15, 20%. There's shortages everywhere of physical gold as well, too. If you called up a coin dealer and tried to buy gold coins, they're out as well. I don't understand that, by the way. I thought that in a free market, you were never supposed to run out. The way you fix that is you raise the price. You're supposed to raise the price enough that you get rid of that shortage. If you have a shortage, you don't have the right price on it. The price should be much higher is where it should be. But that sounds like, there's still a manipulation in the price of gold. So that's what you're trying to do, is get your money out. Cryptos. The problem with the crypto, Bitcoin, why is Bitcoin falling throughout all of this? The problem with Bitcoin falling is that ultimately I can put my money in Bitcoin, but I can't do anything with it. If I ever want to do something with my Bitcoins, I have to swap them back to dollars eventually. I can't buy groceries with a Bitcoin yet. If you could, it would probably be, I understand there's a few hundred vendors that maybe take it here or there. We need several million vendors. We need it to be ubiquitous. If it did, it would soar in price. To that end, about reserve currency, I ultimately believe that the dollar will lose its reserve currency status to some kind of a global cryptocurrency. But that global cryptocurrency doesn't exist right now, and I don't see it on the horizon. I used to, for a hot second, think that maybe Libra could pull it off, but that kind of fell apart too as well. So in theory, I know what the next reserve currency will be. It'll be a global crypto. I don't know if that's 20 years from now or if that's next year, because it doesn't exist yet, a legitimate alternative. What I mean by a legitimate alternative is it's a store of value, it's a medium of exchange. I could go into a Starbucks and I can pay with it just as easily as I could pay with a dollar or a euro or a yen. It's a way from central banks and governments to be able to manipulate it as well too. You give me that, you've got your reserve currency. It doesn't exist now, and it isn't happening next week or next month. So the dollar remains as to what it is. The problem with gold is You need to own physical gold. You can't. If you just own GLD, it's just a better performing version of Tesla. That's all you wind up having, which is why it's struggling like everything else, because it's viewed by that same prism as well.
Very good explanation, Jim.
So now I really upset the gold people by comparing it to Tesla, right? The antichrist of gold has got Tesla.
Let me go back to this whole bailout stuff, okay? Because there's another question here from Jim. He says to you, Jim, you've nailed the pandemic so far, and you've been a real leader in getting information out to the public very early on. While he's also interested in your Fed saving the day discussion, if the answer is no, I can't, what can the Fed save? That is that, I think that you already said that they can save a lot, but he's talking about other things saving. Agency REITs, for example, they're yielding 15 to 20% right now, he says. How are those not saved? Do you think that we end up with a prepackaged BK for the airlines?
He brought up a real good point. Let me bring up this point to everybody. If the bond market is being dysfunctional, and if the problem is emanating out of there, the epicenter, where it's the worst, is commercial real estate. In 2008, it was residential real estate. It's commercial real estate today. Why commercial real estate? Because if I own a $500 million hotel in Midtown Manhattan and I have a mortgage on it, no one's in my hotel. I'm not earning any revenue. Today's April 1st. I owe a mortgage. I owe a mortgage on May 1st, and I'm not getting any revenue on it. Today, April 1st, $81 billion of commercial rents are due nationwide. And I'll give you an example. Cheesecake Factory came out. Hundreds of restaurants in the Cheesecake Factory around the country. I love eating at Cheesecake Factory as well, too. They announced last week, look, no one's in their restaurants. They're not paying their April 1st rent or mortgage on any of their mortgages. Now, those commercial mortgage holders and those commercial mortgage-backed securities holders, they've got rules they got to follow. And I think that the Fed would be better off to stay away from commercial mortgages, because that's big boys talking to big boys here, and say, look, Cheesecake Factory, you're not going to pay your rent or your mortgages on April 1st and maybe May 1st. I understand why. That's not the doubt here. We understand why. Do you bankers that own their mortgages, do you want to take over those restaurants and run them? Absolutely not. You have no interest whatsoever in running them. So why don't you get together with them and work something out? That's why I say big boys talking to big boys. Work something out. So I think if there was ever a place for the libertarian argument, now I'm going to push back on Tom Barrack, Trump's friend of Colony Capital, says that the mortgage market the commercial mortgage market is just under siege. It is. But you're very smart people dealing with very smart people here, okay? You're not dealing with individuals that signed a mortgage that they didn't understand. Cheesecake Factory understands every mortgage they took out, and you understand their business. So get together and work something out between you two. That's a good place to start as well. The airlines, if the airlines want to do a prepackaged bankruptcy, if it's in agreement with their lien holders for their airlines and all of their debtors, go for it. If it's going to be some prepackaged bankruptcy with federal money involved in it, that's where I draw the line. So I understand what the Fed is trying to do in trying to keep the system alive, but there are points where you could say, look, these are adults and they can work something out here, and let them, instead of trying to bail everybody out.
And it goes back to my point about illiquidity versus insolvency. And it seems like thus far they've decided, okay, we're willing to go so far in terms of, where we're going to give the bailouts, but there are a lot of stuff that we're not going to bail out. And high yield's a part of that. We have another question from Owen on high yield, and I'm looking at the time. Actually, we're at 11:53, so we only have 7 minutes. But the bifurcation. You saw the Yum Brands came out, and they were like 5 times oversubscribed. I think they were 6 times oversubscribed. They upped their amount by 100 million, from 500 million to 600 million. So high yield is back, but they're not getting a bid from the Fed, and eventually the fact that there's no bid there will mean that there's going to be defaults. So here's the question from Owen. Has the pricing of bond ETFs like TLT and HYG been restored to close to their net asset values? If so, can we safely own these ETFs to gain from an expected fall in long T-bonds and widening spread between treasuries and high-yield corporates?
Yeah, it has returned. Now, a couple of things there. Let me, before I talk about the ETF, let me make a quick comment about high yield. You know, I mentioned Young Brand. Look at Carnival Cruise today. Carnival Cruise went from $3 billion at 13% yesterday, securitized by their cruise ships, to $4 billion and 12% today because everybody's stepping up. I don't understand that deal, because what am I going to do? What am I going to do with a $400 million cruise ship if Carnival Cruise goes down the tubes? It doesn't. That doesn't do me anything as well too. But the high yield market seems to be coming back. I think it's part of what we talked about earlier. There's still that mean reversion. We're going to go back to January 2020. Don't worry, when the virus passes and everybody exhales, they'll all start booking cruises again, and they'll all start going on cruises one more time. Oh no, the cruise industry is not going to go to zero, but are they going to book enough that we're going to see where they go? So that's what I think is happening in the high yield market. And one other quick comment about high yield and equities, why I think the Fed and the Treasury wants to stay away from that. Because once you start creeping into high yield and you start creeping into equities, high yield, a lot of high yield can be converted into equities as well too.
Right.
You have no ownership in these companies. So if the Treasury created an SPV, a special purpose vehicle, and it bought equities or high yield, and all that got converted, the Treasury owns it. The Fed just financed it. Then Congress steps up and says, wow, we could actually tell these companies how to run. We could actually tell them which slate of directors they should be voting. AOC could raise her hand and say, I want everybody that agrees with the Green New Deal to be voted in on all of these proxies that the Treasury is now holding. Well, maybe she doesn't get away with doing that now, but we don't want the government running these companies. So I think that's why the Fed is going to stay away from high yield because of its conversion, and stay away from equities until it's actually done. Now, to your question on ETFs, real quick, the value of the discount premiums in ETFs has been restored to the extent that it's what the Fed is buying. Is that since the Fed is purchasing ETFs that are backed by investment grade bonds, so they're not really buying TLT as much, those have returned right away. The TLTs of the world, the HYGs of the world didn't show as much movement in their premium discounts. Now, they gotten back there a little bit because the market rebounded, but not because of the Fed. In other words, if the Fed was trying to signal with their ETF buying and their corporate bond buying, everybody, all boats can go up now. Everything's going to be okay. The market didn't take it that way. It said, we're only going to remove the premium, the discounts on the ETFs on only the stuff you're buying. Nothing else is what we're doing. So the market is still not saying that everything is okay. It's just that if the printing press buyer shows up to buy this, well, damn, it's going to go up. That's good. But the printing press buyer is not going to buy that, so it's not going to go up. So that's what you've seen in the demarcation in the ETF market.
Right. Yeah, and that makes a lot of sense to me, and that's where I see it as well. We only have 3 more minutes, so let me ask you this last question. It goes back to the commercial REITs thing that you were talking about, but this time we're going to talk about mortgage REITs, AGNC and Annaly. James Lovely, he's asking, Ed, please get him to address MREITs that own agency papers, AGNC and Annaly, for example. What do you see there?
Well, the agency market has been a problem for a while right now, and that it is, Annaly, I used to be a big owner of Annaly for the longest period of time, and it has really struggled for quite a long period of time. I think that the stage 2 of this problem is going to be where commercial REITs, as I went through, is stage 1. Stage 2 is going to be residential. 3.2 million people filed for unemployment last week. The estimate for tomorrow is 3.5 million new claimants, 7 million plus, 8 million plus, as we mentioned before. That's a lot of mortgages. That's a lot of mortgages that are going to fall in arrears. I understand those people, those people cannot hire 15 Harvard-trained attorneys to represent their interests like Cheesecake Factory can. So maybe they need a little bit special consideration rather than what you would get with the commercial market as well, too. But I do think that you're going to see a problem pop up in the mortgage market as well, too. And if you add in, well, all these mortgages, especially the agency mortgages, well, they're guaranteed. So that just flows through to Fannie and Freddie, which is guaranteed by the government. You then have to start dealing with the idea that we might be returning to an inflationary environment and a higher interest rate environment as well, too. And that would be another dynamic for those mortgages that they would have to deal with that I don't think they've priced in just yet. In theory, rising rates should be good for the mortgage REIT market, but in reality, we've taken all that premium for any rising rate out of it. So there will be a struggle with this initially. Like I said, there's nothing that's going to sail through this without a problem. It doesn't have to be a disaster if we can manage it properly. But we have to realize that we're going from one era to another era is what we're going in, and we're trying to not make it a complete train wreck getting from one to the other. And hopefully we will continue to see it kind of make its way there in kind of a random walk, without it being a complete mess way. So far we've done it. And I do think, like I said, the last message I'd have to leave to anybody about all this stuff is understand we're not going to go back to January 2020 unless you think we're going to forget everything that happened and then we're just going to return to the way that we were in the past. And so we'll have to see where we go from there.
It's a good way to leave it. But Jim, the most important question I had to save for last, and that is, without March Madness, who's your Final Four selection? Who would it have been?
I am getting the shakes because we don't have Final Four, because I am the biggest college basketball fan you've ever seen. I'm a graduate of Marquette University. What I'm really disappointed about was I was really looking forward to their Final Four game on Saturday, beating Princeton. So that's who I had in the Final Four. It's as good as anybody else would have had. Why not? Sorry, Duke. Sorry, Kentucky. Sorry, San Diego State. I know you're in Dayton. You were having fantastic years. But I had Marquette beating Princeton on Saturday.
Excellent. Jim, great talking to you, and let's do it again soon.
Thank you.
Talk to you soon.
Bye.
I hope you enjoyed this special episode of The Interview, the premier business and finance series in the world. What you see on YouTube is a small fraction of what we actually do. So if you're ready to go beyond The Interview, visit the link in the description or go to realvision.com to get access to more in-depth content and expert analysis for just $1 for a month's access. I don't think you can afford not to do that.